Hey friends, how you doing? Today we're going to be talking about execution. Yesterday was about prep. And then wouldn't you know it, we actually crashed live. I'm talking about my tool that we had brought up yesterday. But hey, look, even routine pros trip up every once in a while, but that's the way it goes. Today we're going to step into the fire. We're going to show you exactly how a 0 DTE convexity trader takes a trade. I want to review, though, yesterday's trade and the setup that I had talked about and how that played out. And then hopefully something like that will happen this morning. Typically, these trades will work out somewhere between 9:45 or 15 minutes into the market, right up until about 11 o'clock. And I don't know when it's going to happen, right? So like yesterday, it didn't happen until about 10:55 before we got our first signal. I'm going to review everything. We're going to go through our setup or routine or prep prior to, and then hopefully we'll get a trade. If we don't, we'll simulate one and show you what I do. And we'll talk about the trade entry. We'll talk about the management of that trade and then the exiting of that trade. All right, so let's get to it. So first thing is getting to our chart. Now, as I said yesterday, our preparation is pretty ceremonial. It's the same thing every single time. We're looking for a few basic things. We want to know how big we should size our trades, what direction we're going in, and where are the entry opportunities. And let me review a little bit before we get into all that and why we're doing this. We're looking to put on a convex options trade or an asymmetric trade. And when I say convex or convex strategy, that implies that we're looking for a small risk, large potential reward, but we want to find it in a place where convexity is meeting. Now, if you don't know what convexity is, that is a term of art and science that is saying where the curve is starting to change dramatically, where the rate of change of the price of our positions that we're putting on is getting to a point where most traders are going to shy away, but the convexity trader is looking at that as gold. Now, first thing that we're going to do is look at the VIX and see where we're at. We're not much different than yesterday. We are in the Goldilocks 2 zone, way up here. This is prime territory. The reason why we call it Goldilocks is because it's just like the Three Bears. It's just we're up in the upper half or upper quadrant, or I guess that wouldn't be quadrant if it's half, but the upper half, we call it Goldilocks 2. That's why I have it listed up here in the upper left-hand side here, Goldilocks 2. And for our type of trade, we're looking to put on an out-of-the-money fly 40 to 50 wide. Now, when I say width, I'm talking about each side of the trade. So a 50 wide trade, for some people, might actually look like 100 wide, but the industry standard in describing a trade like that is just to talk about one side. It's a symmetrical trade. So we're looking for a 50 wide trade, or between 40 and 50. And that's not a huge range, but a fairly healthy range. How do I know which side of it that I'm going on? All right. And that's part of what this up here, the big ass fly, debit butterfly with guide range is. We're looking at an indicator that we call the big ass fly, which is nothing more than a 50 wide trade at the money, and seeing what its debit is. And its debit will tell us, should we be heavy on the wide side or narrower on the narrow side? So we'll look at that as well. Okay, so we know approximately how wide we're going, 40 to 50 wide. Now, let me just go back to that and why we're so particular about the width. And that has a lot to do with, let's see if I can bring this up here, this chart right here. Now, everything that we do is gauge specifically on how much volatility there is, because that is going to determine the rate of decay of premium for that day. And that's what we're playing. We're playing that rate of decay. On high volatility days, premium has premium decay has been delayed. That means that most options are more thick and rich with premium, that it's all been held up on to that last 0 DTE day. On low volatility days, it's the exact opposite. Premium decay has accelerated dramatically and there's much less. And I can illustrate that right here. And let me get my handy dandy little tool out, and we'll use, let's use red. So you can see there are two situations that we're looking at. We're looking at high volatility and low volatility. And this is the rate of decay, this magenta line that's coming down here. And each one of these vertical columns is the day before expiration. It represents a day. So we're currently in the 0 DTE day. Now, in high volatility, this curve, this rate of decay, will change so that it is delayed, like you see here. And so that means that on that last day, we have this much premium left. On low volatility, it's the exact opposite. The rate of decay will increase so that on the final day, you only have this much premium available to you. So you can see that is a substantial difference. And that's really what we're all about, is measuring what that difference is. Now, on this chart, you might look at it, yeah, it looks like a difference somewhat, but how does that manifest itself into a butterfly? All right, so we'll show that in a second here, and we'll go down to the next chart. All right, so now keep in mind that big-ass fly that I was talking about. So we have these two situations. We have high volatility and low volatility. Let me get my annotation out here again. This time I'm going to use green. Green will look better. We're definitely not in low volatility, but we are in high volatility. So the way that rate of decay manifests itself, in accelerated decay, you can see that the butterfly will, if we're looking at a risk graph, will sit very low on that risk graph, leaving very little profit potential. This is your profit potential from here to here. All right. So you have large risk and not a whole lot of reward, right? The other problem is that our real-time profit curve is very steep, and that's going to be very important. Now, in high volatility, it's exact opposite. You notice that the butterfly now is sitting high, and the risk itself, or the debit of that fly, is relatively small, yet the profit potential is huge. So starting this morning until the end of the day, we have this much potential to go to. All right. So you can see, obviously, there is a mammoth change in the profit potential, the risk, and also something else that I wanted to talk about, and that is this premium curve, this versus this. So let's take a look at that in a little bit more detail. Your real-time profit curve, the slope of that, or that next derivative of that, would be the sensitivity to price. So you can see in a low volatility situation, a given move that goes, let's get the annotator back, in a given move, let's say 10 points, the drop is rather significant, right? So that's the slope, or this tangent line to the curve. That, my friends, is called gamma, your sensitivity to price. So in low volatility, not only is your risk huge and your profit small, but your gamma is also very high. And that's a difficult thing to adjust to. So that's why in low volatility times, we have to be much more deliberate about what we do, much quicker on our trades, take quick profits, not hang around too long, even though you would think that low volatility is giving us plenty of time because things are a little bit more sanguine and easy. It couldn't be further from the truth from a 0 DTE trader's point of view. We don't have as much profit potential, and the risk is higher and the sensitivity to price is higher. We have the exact opposite here in high volatility. In high volatility, we have very low sensitivity to price movement. So that same given 10-point price move is going to result in a very small amount of change in the value of our fly. And that's because gamma is very low. And the exact opposite now, we have very little risk and very large amount of profit. And as I said yesterday, our primary goal is to get risk-adjusted returns. And so in this particular case, our risk-adjusted returns in high volatility is much more Goldilocks-like. And that's what we're really looking forward to. Now, in order to adjust to these different situations, how do we do that? Here's the primary thing. We're trying to keep a common or a range of risk to reward that we're doing. How many dollars that we put up for the potential profit. In low volatility, we have to choose a width and keep a risk to reward that's about the same as we trade all times of the year. So our range for risk to reward, we have, in other words, you have to decide how much we're going to put down for any particular trade. So we have something called the 10% debit rule. Now, let me get back to the big head here, and I'm going to tell you a little bit about that 10% debit rule. Back in the dot-com era, I've been around for that long and more, I was a chief architect for Sun Microsystems. And at the time, I was in charge of all of our Tier 1 clients in professional services. I had a very large team of architects. We ran virtually all of the major projects that were happening at that time for our Tier 1 clients, which were mostly on Wall Street and the big insurance companies up in the Northeast. And I had an office down in the World Trade Center and would spend a lot of time down on Wall Street and would often go down to one of the exchanges or the NASDAQ, whatever, or the American Exchange and see projects going on. And I got an opportunity to hang out with some of the traders there, and this is where I actually learned about this asymmetric opportunity on butterflies, because they were trading butterflies out of the money and using the 10% debit rule. And at the time, it sounded interesting, but I didn't pay much attention to it, and it wasn't until years later that I started to understand why they were doing that. But in any event, we adopted that 10% debit rule here. Actually, I adopted it a little later, right around 2015, that would have been about 15, 16 years later, and started to see the efficacy of that 10% debit rule, which ended up in a 1-to-9 risk-to-reward ratio, which is very different than what most traders are looking at. Most are looking at the exact opposite. They're looking at usually a 9-to-1 risk-to-reward ratio. They're putting up $9 to make $1. And they don't even do that. But that's another story. So 10% debit rule, I found, was a maximum that you would want to take on as far as risk on a butterfly. So that meant you had to push the butterfly out far enough so that the debit was only 10% of the width. I found that was, like I said, the max that you would like to do, and it was actually a range that you would want to trade in, somewhere between 5% and 10%. So if it was a 10-wide fly, you didn't want to pay any more than $1, but not much less than $5. So somewhere between $5 and $10, or in option speak, 50 cents to $1. So that's what we're looking for. We are trying to keep our butterflies about that, in that range. That's where you're going to find optimal convexity. So I wanted to say that because now when we go back to that diagram that I showed you of the butterflies in two different situations, whether it's low volatility or high volatility, we're trying to keep our butterflies in this approximate range. Now, if we do that, in order to trade effectively in those different volatilities, we're going to have to dramatically change the width of our flies so that we can adjust for that change in rate of decay. So what happens then is that in low volatility, we end up putting much narrower flies on, and in high volatility, we're able to put on much wider ones, and that is because the risk is much smaller so that we can put on wider ones, and with low volatility, the risk gets much higher, so we have to put on narrower ones. It also makes sense, too, because in those two different environments, your expected move in low volatility is going to be much less, so narrower would bring you closer to the money, which would make sense. And wider ones would make sense in high volatility because the expected move is wider. So that's the reason why we change the widths. And after doing thousands and thousands of these trades, and through my own empirical evidence and experimentation, I've started discovering what trade widths work best in those different situations. And that's why you see when I bring up the VIX, you'll see that it's actually a playbook. And let me bring that up here again. It's actually a playbook based on that volatility level and where I'm going to trade. So this is what was born out of all of that from the time I was on the American exchange and watching these pro option traders to today, after thousands and thousands of these trades and showing really tremendous success, that I would change that width based on what I'd showed you before, the rate of decay. So that's how we've come to it. And then how do we get to this more nuanced, what side of that width do we be on, 40 or the 50? We look at that exact same diagram, but in real life. Let's see if I can bring that up. All right. Is this a 50 wide? No, it's not quite a 50 wide. Let's see if we can put a 50 wide on at the money. All right. So here's a 50 wide at the money butterfly. We call this the big ass fly. And so I'm looking at the debit right now. And the debit on this guy is around $16.51. All right, so now we go back to our guide here, and we see that $16.51 is way over here, right? So that means that we're on the wide side of Goldilocks. So here's the debit scale. Goes all the way down to 3. I've seen it this low, believe it or not, a butterfly at $3.50, and I've seen it as high as $35 for that same at-the-money 50-wide butterfly. So this is telling us that we should be on the 50 wide, definitely to the left of 20. 25 is like our limit. That's another story. We'll talk about this trade at some point later in another show. So I'm looking for a 50 wide fly, right, that is going to have a risk to reward somewhere between 5 and 10% of the width. So if it's 10% of the width, that would be $5. That's a pretty hefty price to pay. Or it could be as low as $2.50. A fly that's somewhere in that range. All right. So let me just ask, if you're enjoying this content, please give it a thumbs up right now. Make sure you subscribe, right? And leave a comment. Put a comment in the comment section. I'll be looking for it. Just to say that, let's bring up the comment window. I see no comments yet, but I do see 12 thumbs up. Come on, give me some more thumbs up. And we'll get into this in great detail. All right. If you have any questions, please ask. Let's get to all right. So we can see clearly. Oh, let me show you something that's interesting here. By the way, this is my fly in the wall tool. I developed this. And over here is a convexity heat map that allows me to see that range of prices across the entire options chain. And I can quickly see where convexity is happening. That's where these red areas are. This will start developing later on in the day, and it will start becoming more and more stark. But this allows me to find where the convex positions are. And this is all set up for butterflies. I can also look at it from a vertical point of view, or butterflies, or singles, etc. Up at top, the cross are the different widths. So I'm looking at 50 wide. And that's how I created this 50 wide fly so fast. I was able to find a 50 wide and then go right to the money. That's what this yellow line is here. And then pick it almost immediately. And that's one of the conveniences of this tool, that I can find a fly a butterfly or a vertical or anything that I'm looking for in an instant, where traditionally, if you went to your Thinkorswim or Tasty or whatever platform that you're using, you're fiddling around trying to figure out what fly you want to use or what option strategy, and it takes you, 5-10 minutes before you find it, and you don't even know if it's optimal. Here, I can see it in an instant, pick it, choose it, analyze it within 10 seconds tops. So it saves you unbelievable amount of time, plus I see what those flies are in context. That's all in this fly in the wall system. And as we get into it, you're going to start to realize that this system and this app is far more capable than your Thinkorswim or your Tasty app, and will get you to the trades that you want far quicker. So if you're interested in that, to go down below, become an observer. That's our trial tier. You can try that out for 4 weeks and see for yourself. You'll also join our Discord where we are talking about this stuff every day. And you'll see trades going on. You'll see other traders that are practicing zero DTE trading and in a convex way. Still wondering where the GEX chart is on the fly on the wall. Oh, okay. Then I guess we have to show you. And I'll show you that in just a sec. Over here is the risk graph, right? But you can view the GEX simply by clicking this button up here, and it brings it to you right away. If I hide the risk graph, here's your GEX, right? So answer your question right away. We can also bring up the volume profile behind it to see our volume profile in concert with our strategy, which I just got rid of. That would be a total disaster if you accidentally deleted your risk graph with your Thinkorswim or Tasty, because you'd have to go and then recreate the whole darn thing. I don't. I just go over here, one click, and I'm right at it again. All right. So we'll get into the GEX and the risk graph later on. Fantastic. Thanks for that question, by the way, James. All right. Let's take a look at what happens in different volatility moments. So I'm going to unlock this and show you what this would look like in different volatility regimes. And so the way I'm going to do that is use this what-if analysis at the bottom. And right now you can see our VIX is sitting at about 28. But if I were to bring it down to a lower VIX, let's say around 17, now look at the difference there. See how the whole thing just shrunk down, and now my risk is way bigger and the potential profit is smaller? And the steepness of the curve is much bigger. Now watch, I'll bring it back up to where we are now. And like I said, I've seen, just the other day, it was closer to here, and I've seen it as high as this. You see how now what you're really witnessing there is the acceleration and deceleration of premium decay. In a high volatility moment, we have a deceleration, leaving us much more profit potential. Now we're currently right about here. There you go. So there's the perfect demonstration of that difference that I was trying to show you. All right, and this is a good situation. We have lots of premium potential and so forth. All right, so let's find a trade to put on. We're going to go 50 wide. We would like to find a trade between $2.50 and $5. And I'm going to bring up the annotation screen and just show you that. We can see right here, where are our trades? Right there. Might have to squint a little bit. Sorry about that. This will allow us to find that trade very quickly. And I can see that there's one for $5.15, then $4.32, and it's starting to drop off. Biggest drop off here is between $2.70 and $2.22. If you were going to do a trade for, say, $2.70 or $2.60, would you rather do it for that or just go one more strike out and pay 25% less? That's the whole deal here. Of course, I'd rather go one more strike out. You'd never know that, though, if you were steeped inside of your options chain trying to figure that out. But this allows me to pick that very quickly. I'm going to choose $3 just for that and bring it up. So there's our trade that we're potentially going to put on today. Now, I'm not saying I'm putting this one on right now because that's only part of the game. I know that this is something like the trade I want to put on, but I want to put it on when there's an entry event. And I still haven't gotten to everything that we're looking at. I just got into the VIX right now to show you the width and so forth. Now we also have to look at volume profile and market structure. And there's a lot of ways that we can, this is an alternative view that you can look at your strategy, and you can put the volume profile up there. And you can view your strategy as price is going towards it. The white lines are the strikes of your strategy, and the green area is the real-time premium. And so you can see our price moving up into it. All right. Now that's a call fly. That may not be precisely what I want, but I'm just showing you the different views here. So we have these orthogonal views of our strategy in the tool. Let's see. So if the GEX isn't working on your setup, then put a note in the Discord. All right, and we'll get to it, and I'll be able to attend to it after this thing. So Jerry's asking, good morning, Coach. Your heat map where you can pick a trade saves an unbelievable amount of time in choosing the butterfly trade strikes. Thank you for that creative tool. You're welcome. And let's see. Does it show you gamma? Yes, it does. All right. So I just updated this, James, yesterday, so you may have to do a hard refresher on your, all right? So let's get back to what we're doing here, and we're going to our volume profile. So the next thing that we need to do is figure out where structure is. And the way I do that is about once a week, maybe every 2 weeks, I am marking up my volume profile on my chart. I went through this briefly yesterday, and I'll do a whole show on it sometime in the future. So let's turn on our volume profile. And as you can see, I've already marked it up and showing where the structural lines are by finding where the nodes and the deep crevices are, and then marking them up with various colors. So that's where those lines are coming from. So when I go back to my 5-minute chart, there we are. And at this point, I don't really need my profile anymore because I have my structure. Now I want to point out these vertical lines are my session lines. This is yesterday, by the way. And yesterday I pointed out these two scenarios that could have happened. I felt that we could have pulled up into one of these structural levels. And in fact, we did. We pulled up right here. And that would have been your trading event right there. And so here's today right now. And so we're looking for something very similar. We're looking to pull up into one of these structural levels. It looks like it may be this one here today. So who knows? We may get an opportunity to put that trade on during the show. But you can see yesterday it pulled up to that structural level, and then we would put on a butterfly down below. I'll just demonstrate that right now. We would have put a butterfly down here, and it would have moved right into our fly. So that's exactly what we'll do today. We'll put a butterfly down here using our picker. All right, and we're just about there right now. Now, how do I know that's going to be the level? I really don't until I start looking at some of our tools like the gamma and seeing if there's a gamma wall there and start evaluating whether or not there's potential that level is going to provide structure and then reject price. Why am I taking a put fly as opposed to a call fly? How do I know it's not going up or down? I don't. I really don't. But we are definitely still in a downtrend. And so my overall bias is definitely down. All right. So that means I'm doing a put fly. So now I know just about everything I need to know about this trade today. Let's go back to the big head and just talk about this for a bit. I've done my prep. I know where volatility is, how wide I'm going to go. I know that I'm going in I have a bearish bias, so I'm going to put on a put fly. And I know about what size I'm going to do. And I have a good idea of where those structural levels are, and so where an event is likely to happen. And it looks like one of those events may be happening soon, although we just blew through that structural level as we're talking. And that's my opportunity to analyze that area and find out whether or not there's a good chance that it might be the structural level above, or if we are indeed going to find that level as our go-to place, right? Okay, let's go back to the charts. And as I was talking, you can see we blew through it, but we're coming down. We're not looking for an exact hit on these levels, although it happens quite often. You'll see that a lot of times we're just hovering in that area. The market is like a swarm around those structural levels. And in fact, you can think of the gamma as that swarm, and then the volume profile as the aftermath of that swarm. And these structural levels showing that aftermath. And those levels get revisited all the time. So yesterday I put on these scenarios and they worked out. Today that's exactly what I'm doing, and I could say that we may have another one up here. It's very possible that we could get a big boost and do something like this, but even if it comes up to here, as long as we're within that morning session, I'll still take that short. But let's suppose that this is the place that we want to take that short. So we'll just go to the put side on the heat map, and we'll find a trade down here. Looks like somewhere around there would be good. I can adjust the gradient so that I can see more clearly where convexity is happening. And so I can see between 341 to 292, it's about a 50-cent decrease right there. Or even between 380 and 330, it's another 50-cent decrease with just one strike. I would say that either 331 or 294, one of these two are good. I'll choose the 331 for now, just for argument's sake. Put it up here, and there's the trade that I would be looking at today. All right. We can look at an alternative view, an orthogonal view, I call it, by looking at it from the top side. What I'm really saying is that imagine if you could look at this from the top side, then you could see it in terms of price. You could actually see the price action. So that's the view that we're going to be looking at by simply clicking on time here. So now we're seeing price from the top side. And let me get rid of the volume profile. All right, if you look closely, I have the sessions all marked up here. You can turn the sessions on and off. We're in the morning session, and then the afternoon, then the closing. And so here's our fly for that entire session, and then here's where the profitable area is. So we're really looking for something like this to happen. Let's use purple. So we're looking for something like this to happen, and then move into our fly, right? Assuming that structural level is going to hold. Now, we can mark up the structure right on our chart, too, and see the volume profile. So that level that we were talking about is right on the top side of this node here. So we're actually in a node, but at the top side of it, that's where it's providing that structure. And it's like there's a good chance that we'll stay within that node. Moving above it is also a possibility. We can look at it from this point of view and look at it at our GEX. And we can see in order to come down into our fly, we're going through what we would call a flip zone. And that's what these little dots are indicating, 0 gamma, this flip area. But if we do, we'll be attracted by these high gamma walls here. And so you can see there's a lot of dealer activity here. So right here, it's tenuous where we're going to go, whether we go up or down. Maybe we can take a look at it from the total point of view. All right. So in my estimation, this is a good trade. It looks like there's good potential for us going down into our fly that we've chosen. And if not, then we've only taken a small risk. Need some coffee. So this will be the trade. We'll look at this tomorrow and see how it panned out. But let's talk about what could happen today. Let's assume that everything went our way and price came into our fly. So we can do that what-if analysis and see what would happen from now until the end of the day. Now, we can do that by turning on what if, and right now we can see where our profit curve is, but what's it going to be like at noontime? Right now it's right around 10 o'clock. I can just move my time thing and it will adjust my butterfly. What we really want is one spot there. Okay, so I'm going to go to the big head now and talk about this in a little bit more detail. All right. So what we're looking for is a move into our fly, and at some point there's going to be some profit generated from that. And I'll demonstrate that in a second. Here. Just getting my annotation tools up so that I can demonstrate exactly how we would manage this fly. There we go. All right. So let's say that the price does move in our direction. So as it's moving up into here, I'm going to be achieving some level of profit. So let's say that it reached to here. When it reaches there, what I'm doing is I'm looking at what level do I take profit. Let's talk about that a little bit. Profit management in our particular case, and risk management. Are we actively managing risk? The answer to that is a qualified no. The management of our risk is actually in the strategy itself. So we're not managing it per se. We're managing it by defining our risk. What we're really focused on is the profit that has been achieved, or the unrealized gain. And we're not so much concerned about that risk because we chose that extreme risk to reward as a long-term risk strategy. So that if you were to look at your position size in that realm, you would pick a position size, and it isn't solely based on the size of your fly. We know that we put on a fly that's 50 wide and we paid $2 or $3 for it. That's $300 that we put out. Would that represent our maximum position size? That would really depend on how big your account is. So if your account was, say, $100,000, $300 might be small on the small side. You might want to put on 2 or 3 of these positions, maybe get up to about 1% of your total capital. If you had a $25,000 account, yeah, that might be near your maximum, only 1 position. We would right size the trade based on the position size that we put on, or maybe even push it out a little further if we want to adjust that price so that we can afford it. In any event, you might think, if I push it further out, Coach, what's going to happen to it? It's going to be further away from the money. How will I get into the fly? Here's the thing. That's not your goal. You're not trying to get inside of the fly tent. That profit curve is all you're really focused on. About 75% of your profits are going to happen outside of the profit tent itself. And from there, you're going to have opportunity to make anywhere from 50 to 250% return on the risk that you take. So that's where you want to remain. That's where you want to focus on. Only about 12.5%, maybe 15% of the time will you actually get into the profit tent or remain there. And that's great, and you want to play those, but it's not something that you can count on. It's about the same odds as putting on a long call or a long put. You know that only 12.5% of the time does a long call or a long put end up in the money. It's the same deal here. About that same amount of time, we end up in the money or in the butterfly. But that doesn't mean that we can't make money with that optionality prior to that. So the way we manage profit is that we're looking for some minimal amount of profit to make before we start managing it. And so typically what will happen is price will move towards our strategy, and we'll notice at some point right around 75 to 100% of our risk will have been achieved. So if I'm looking at this particular strategy, it cost me $3, I'd be waiting for it to get up to about, I don't know, $200 or so, up to about $3 of profit before I start actively managing it. And then at that point, I would put on a trailing stop. Now, you can do that programmatically or you can do it in your head, but I would put on a trailing stop and I would always keep track of the maximum profit that I have achieved. And then I would mark up with alerts, exactly where I would be getting out. So now the trailing stop is going to depend largely upon where and when you are. All right. And we're going to talk about that in great detail tomorrow, by the way. The trailing stop depends on where and when you are. And what do I mean by that? Over the course of the day, you know that your premium is decaying consistently over that period of time. And so as time moves on and that premium decay is occurring, that means that the profitability is moving away from you and the gamma is getting steeper. In other words, the profit curve is getting steeper. So you have to become more aware of that. If you're in profit, that means that in the beginning of the day, you can have a wide trailing stop, maybe as much as 75% of the profit that you currently have. Then as you start moving into the afternoon, that starts narrowing up maybe to 50 or 40%. And then if you are still in the trade in the afternoon session, you might bring it down to, say, 30%. Or at that time, you may even be inside the profit tent. If you're in the profit tent, then I would use the profit tent itself as your guide to stay into that profit. So by managing it this way, you will optimize the profitability, and you will know exactly when you need to get out. And that is when that stop or that trailing stop has hit, because that is all designed to put you on the right side of gamma, or the sensitivity of the price, that slope of that profit curve. We'll go over that in excruciating detail in future episodes, but I just wanted to frame that for you. And tomorrow we'll go over this trade and how it worked out and exactly how we managed that. But I wanted to give you that high level view. That's what we're doing. We're finding that starting point, which is typically around 75 to 100% of the risk that we took on, setting our trailing stop. Typically, I do it with an alert, and then dynamically adjusting that trailing stop as we go to higher and higher profit, if we do, or if it reaches the stop and then I exit the trade. And that will give me the optimal amount of time to stay in that trade right through to its completion. Sometimes 75% of the time you will be exiting outside of the profit tent. About 25% of your profits will end up in the profit tent. And about the other portion of the time, it'll go the other way, and you'll take the loss. And we'll talk about that in detail too, and what that actually means, and what will happen over the long term when you follow this strategy. Following that strategy in the long term is going to result in surprising things. One is that it's going to lower your drawdown dramatically, keep it within 5 or 6%. And your profits are going to look very interesting. You're going to find that most of the time you're playing for even. You'll have small wins, small losses, and then you'll have big wins that will elevate you, right? And then small wins, small losses, like a stair step. But what you won't have are these big loop-de-loops. All right. So that's about all the time that we have for today. We'll take a look at this trade tomorrow, and we're going to look at reflection. So that will complete the loop for this week's series. There's preparation, execution, and reflection. Tomorrow we'll reflect on the trade, see what the result of that was, and then the things that I do in order to record that daily experiment. That's all I've got. I want to thank you very much. If you want to learn more about zero DTE trading, the convex way, go down below and join Fly on the Wall, become an observer. Thank you. And don't forget to give this a thumbs up and subscribe. Talk to you later. Have a great day.